be recovered soon or not to be recovered soon? That is the question. And this week, Federal Reserve and Treasury Department officials didn't do us a whole lot of favors in providing us an answer. Stock and bond markets were about as confused as everybody else and didn't make much progress. So today, we'll be running through the data for ourselves and find out where we really are in the recovery. Let's get into it. This week we had a bit of confusion in the markets with different officials saying different things and even economic indicators telling a different story depending on what you look at. Richmond Federal Reserve Bank President Thomas Barkin said on Monday that he hopes the U.S. economy is on the brink of a recovery. He sees vaccines rolling out, new cases and hospitalizations falling, and savings and stimulus funding pent-up demand from consumers. Meanwhile, Fed Chairman Jerome Powell also said on Monday that while he sees the U.S. economy strengthening, the recovery is far from complete, especially given that the unemployment rate is still elevated at 6.2%. And just to muddy the waters a bit more, Treasury Secretary Janet Yellen added her voice to the mix and sees the economy growing and possibly returning to full employment next year, thanks to the $1.9 trillion stimulus package President Biden ushered through Congress this month. Honestly, I hope she's right. If you can't get full employment after pumping $1.9 trillion into the economy, you might need to go back to the drawing board. After all, that's nearly 20% of what all U.S. employee wages are for an entire year, according to statistics from the Bureau of Economic Analysis. Add to that another $3 trillion in economic stimulus the Biden is currently planning, and we should be able to hit full employment even if we have trained monkeys in charge of distributing the funds. So, which is it? Are we on the brink of recovery? Is it a year away? Enough of the hype. Let's let the data speak for itself and see where we really are in terms of this recovery. Here we have a graph of total retail sales in the U.S. over the last 2 years. When we look at where we are now compared to the pre-pandemic peak, we see we're currently 6.2% above that point. So, yeah, retail sales have definitely recovered. How about non-farm payroll employment? Comparing it again to the pre-pandemic peak, we're still down by nearly 9.5 million jobs. We have definitely not recovered in the labor market. Keep in mind that during the Great Recession, we lost a total of 8.7 million jobs during the entire recession. This is no small amount of jobs we need to add back for a full recovery. So when you hear Fed Chairman Powell use words like scarring when it comes to his worries on the labor market, this is what he's talking about. And it's not a small issue. How about the stock market? I don't think I even need to draw anything on the graph to point this out, but yeah, we're up 15.5% since the pre-pandemic peak last year. It has most definitely recovered. Let's look at one more. Here's industrial production for U.S. manufacturers. From the pre-pandemic peak, we're still down 4.2%. Definitely not recovered here either. I'm starting to see a bit of a pattern here. For indicators that are measured in dollars, like retail sales or stock prices, things seem to be doing pretty well. But for indicators that are a bit more connected to the physical world, like jobs and factories, we still have a long way to go. If you haven't figured out why that is at this point, look no further than our money supply growth over the last year to see why there is so much liquidity out there right now. One of the most comprehensive measures we have for the economy is real gross domestic product, which is basically the sum of all expenditures in a given time period. It's everything we buy and sell, goods and services. Right now, real GDP is still down 2.4% from its pre-pandemic peak. So by this comprehensive measure, we still haven't recovered. But back to Fed President Barkin's comment, are we on the brink of a recovery? In our own GDP forecast we just released today, we are currently projecting GDP to grow at a 7.3% annualized rate in the first quarter. We'll see next month when the government releases their official estimate how close we get to the mark. But if this rate of growth is realized, we should see GDP within just 0.7% of that pre-pandemic peak. If you would like a copy of our free GDP forecast report for this month, check out our website at papaycast.com, and you can subscribe there to get a PDF report in your email inbox each month with our latest analysis. With all this confusion, we got a lot of sideways action from the markets this week, and understandably, it's hard to steer when you can't see what's ahead. Bond rates have managed to stay in a narrower range, absent more indications that inflation is on the way, which will help in credit markets by keeping growth on lending rates like mortgages in check for now. The yield on the 10-year Treasury rate has come off the recent highs and is currently settling in below 1.7%. Looking back on this confusion over the last week, I think the Federal Reserve and the Treasury Department need to look back at how things like this used to be handled. Here's former Federal Reserve Chairman Alan Greenspan testifying to Congress during his time as a chairman.
As I have noted previously, we cannot be sure in an environment with so little historical precedent what degree of labor market tautness could begin to push unit costs and prices up more rapidly.
I have no idea what he just said, and that was kind of the point. If you've enjoyed today's episode, please give it a thumbs up to support the channel, and I hope you will consider subscribing if you haven't already, and hit that notifications bell so you'll know right away when our next weekly Econ update is published. I'll see you in the next video.